You see them in finance videos, apps, and social media. Everyone says ETFs are the smartest investment for beginners. But popularity doesn't mean safety. Many beginners lose money because they follow trends instead of understanding what they invest in. In this video, we'll break down why ETFs may not be ideal for beginners and why index funds often work better. This is not hate against ETFs. It's about choosing the right tool at the right stage of your investing journey. Let's start with the basics. ETF stands for Exchange Traded Fund. An ETF is a basket of stocks or assets bundled together into one product. ETFs are bought and sold on the stock exchange just like regular shares. Their prices move continuously throughout the trading day. This constant price movement affects how investors behave. Now let's talk about index funds. An index fund also tracks a market index. Examples include the S&P 500, NASDAQ 100, or Nifty 50.12. Index funds are bought directly from a fund house, not traded like stocks. They are priced only once per day after the market closes. This single difference creates a huge behavioral advantage for beginners. On paper, ETFs and index funds look similar. Both are passive investments. Both are low cost and designed to follow the market. But real-world investing is about behavior, not theory. And this is where ETFs start to cause problems for beginners. The first major issue is overtrading. ETFs are too easy to trade. Beginners constantly check prices and react emotionally. When markets fall, fear pushes people to sell. When markets rise, greed pushes people to buy late. This emotional cycle destroys long-term returns. Index funds remove this temptation completely. You cannot trade them during the day. This forces patience and long-term thinking. Discipline is one of the biggest advantages in investing. And index funds automatically build discipline into your system. The second ETF problem is the bid-ask spread. This is the gap between the buying price and selling price. Every time you trade an ETF, you lose a little money here. These losses are invisible but very real. Over years, spreads quietly eat into your profits. Index funds don't have this issue. You buy and sell at the fund's actual value. This makes index funds more cost-efficient for beginners. Another ETF risk is liquidity during market crashes. Some ETFs trade below the value of their underlying assets. This means extra losses during panic situations. Index funds are valued calmly at the end of the day. This protects investors from panic-driven price distortions. ETFs also come in dangerous varieties. Leveraged ETFs multiply gains, but also losses. Inverse ETFs profit when markets fall. These products are not meant for beginners. Many beginners don't fully understand these risks. Index funds keep things simple and transparent. No leverage, no tricks, no complexity. ETFs encourage market timing behavior. Investors try to predict perfect entry and exit points. Even professionals fail at timing the market consistently. Many beginners don't fully understand these risks. Index funds keep things simple and transparent. No leverage, no tricks, no complexity. ETFs encourage market timing behavior. Investors try to predict perfect entry and exit points. Even professionals fail at timing the market consistently. Index funds focus on time in the market instead. Long-term compounding works best with patience. Another issue is ETF tracking error. ETFs may not perfectly match index returns. Index funds usually track the index more accurately. ETFs are better tools for experienced traders. Beginners need simplicity, not excitement. The goal of investing is freedom, not adrenaline. Final lesson: for beginners, index funds usually beat ETFs in safety, discipline, and long-term growth.